I'm always skeptical when I look at a listing that says, "This is a great investment opportunity," and the listing agent doesn't supply any supporting data. Sometimes they'll throw out a cap rate like that's supposed to mean something when there's no supporting data. Because when it comes to cap rates, I always recall back to when I got certified in real estate financial analysis. My instructor told us two things about cap rates, and that was number one, and this is a quote, "We use cap rate all the time, and the strangest paradox is hardly anybody knows what it really is." Then he gave us his definition of the term cap rate, and he said cap rate is a lie divided by a fantasy. So you can certainly understand why I'm always skeptical when I read a listing that says, "Great investment opportunity." I always have to crunch the numbers for myself, and that's what I'm going to do for you today. Hi, I'm Bob Wolverton. I'm with Pure Real Estate in Bellevue, Washington. Here on YouTube, I'm known as your Northwest Realty Advisor. When we come back after this 8-second break, I'm going to look at a brand new listing in Everett and just do a really quick, light overview of crunching the numbers to see if it has the potential to be a great investment opportunity. So stick around. I should start this segment with a brief mention of the future of the real estate market. I'm seeing more and more YouTube videos talking about a housing crash that's going to be worse than ever before. The first thing you'll notice is these creators, with their opinions, do not give any supporting data. I saw one video this morning about how there's more mortgage debt in our country now than ever before, and it was presented as a precursor to the worst housing crash ever. I mean, it's like dogs and cats are living together. Oh my, what are we going to do? While it is true there is more mortgage debt in our country now than ever before, that is not an indicator that the market is going to crash. When you look at the bigger picture and the fact that our population is larger than it's ever been, and our salaries are higher than they've ever been, and here's the important part, mortgage debt as a percentage of disposable income is actually lower than it's been in the last 40 years. That's a more accurate reflection of what's really going on, and in all reality, that's positive news. So make sure you get your real estate market news from a trusted professional, somebody like me, or you could end up like a lot of people who decided it was a good idea to go short on Tesla stock. And that didn't turn out well now, did it? And you know who you are. So if you don't want to be one of those people, click the subscribe button now. Okay, let's get started with a little investment analysis. For just a moment, let's return to the idea of what so many people talk about, and that's the cap rate. What most people don't understand is the cap rate is the rate of return you get when you pay all cash, which is crazy in today's market since borrowing money is so cheap. That's also called the power of using other people's money. The idea is to control an asset for the least amount of cash possible and have that asset appreciate for more than the loan is costing you. That's the power of other people's money. But aside from cap rate, I focus on using an internal rate of return as my calculation, and here's why. Internal rate of return, or IRR, is always a more valid measure because it contemplates reality and what's happening over an anticipated holding term. Cap rate freezes a moment in time. Cap rate really says, what's the property worth today, knowing only what the income stream is. Internal rate of return allows you to contemplate future outflows and inflows and appreciation, whereas a model of the cap rate doesn't let you look at any of those. So I believe internal rate of return is far more accurate in estimating the return on your investment, and internal rate of return also factors in an exit strategy, whereas a cap rate doesn't do that. So let's look at this property that just came in the market, where the listing remarks said this is a great investment opportunity. Let's look at my multi-page spreadsheet that I use to crunch the numbers on a potential investment property. Remember, we're not going to go into great depth here, just a high flyover. This property is located at 4602 South 4th Street in Everett, Washington. It's listed for $399,500. We're going to set our exit strategy at 4 years. In essence, we only want to own this investment for 4 years, and we are doomsday investors. So in this example, we'll say in the next 4 years, this home will have zero appreciation in value, which in our market is pretty ridiculous, but let's look at the worst case scenario. So with 0% appreciation, that means in 4 years, the home we just bought for $399,500 will have a market value of $399,500. That's zero appreciation. Since this is a rental property, we'll have to make a down payment of 20%. So our loan will be 80% of value, which is $319,600, and our 20% down payment equals $79,900. The current national average for a 30-year fixed rate mortgage is 3.78%. So that's what we'll put in and where we'll start our calculations. Now we'll go to the next page, the loan amortization page. On this page, we see all the loan information we just talked about, and we see our monthly principal and interest payment is $1,486 per month. Continuing down the page, we see our annual debt service, or the ADS column, for each of the 4 years that we hold this property as an investment, and the annual breakdown of interest and principal paid. You see at the end of the 4 years, our loan balance will be $294,830. We also see that number if we scroll down to the bottom of our amortization schedule, where we see after payment number 48, our loan balance is $294,830. Now we go to the next sheet, the APOD form, or Annual Property Operating Data Sheet, and we are showing this as a single family residence, so this is one unit, and our monthly rent will be $2,000 per month, which is a very competitive rent for this neighborhood. I'm not showing any vacancy rate on this page. I'll add in a vacancy variable on the next sheet. But on this sheet, we see our annual income from the rent is $24,000. The annual property taxes on this home is $2,637, and we can anticipate paying about $500 a year in homeowners insurance. As we scroll down to the bottom of the page, we see our total annual expenses are $3,137. Subtracted from our annual rent leaves a balance of $20,863. Then we subtract our annual mortgage payments, also known as the annual debt service, of $17,827, which leaves a positive cash flow of $3,036 for the year. But we didn't calculate any vacancy factors, so let's do that on the next page. On this page, for potential gross income, I'm showing at the beginning of year 3, we're going to raise the rent by 5%, which is $100 per month. I think that's pretty reasonable. At the same time, I'm showing in year 3, we can anticipate our expenses will increase by 5%. Now down below here, you'll see in year 2, I subtract 1 month's rent as a vacancy, estimating that perhaps at the end of 2 years, our tenant may move out and it will take us 1 month to get a new tenant in place. You'll see when our new tenant moves in at the beginning of year 3, our new rent increases our gross income. And again, at the end of year 4, I'm estimating we'll have 1 month vacancy as we put the home on the market for sale. In this table, we see our annual estimated expenses, our net operating income, our annual debt service, which doesn't change because we have a fixed rate mortgage, and our pre-tax cash flow for each year. Now we go to the next page, pre-tax sales proceeds, and remember we calculated zero appreciation, which means we are selling for the same price as we bought the home for, which is crazy, but just for a moment, let's see what the numbers say in this scenario. Remember, we calculated the cost of the sale at 7%, figuring this will cover your real estate commissions and your real estate excise tax that you have to pay when you sell. And then we have to pay off the mortgage balance. As we remember from earlier, that was $294,830, leaving us pre-tax sales proceeds of $76,705, which I'll tell you right now, spoiler alert, this as an investment sucks. We go to the sub-calculations page and see our down payment of $79,900. Our minimum positive cash flow for each year, and year 4 includes the positive cash flow from the rent for that year, as well as our sales proceeds. And overall, we earn 2.2% APR on our investment cash, which was the down payment of $79,900. Now, the reason I showed you this is because if you're a doomsday economist, even with 0% appreciation, you're not going to get hurt in this investment. But 0% appreciation in our market is ridiculous. Now, if we look at the national average of projected home price appreciation going forward, it looks like if we plug in 3% appreciation, that's pretty conservative. Our area with the strong job market we have has been higher than these national averages over the years, but let's continue being conservative. So we go back to the first page, and the only variable we're going to change is the rate of appreciation. We'll change that from 0% to 3%. You see that immediately changes our proposed future sales price from $399,500 to $449,641. All the other numbers we looked at previously will remain the same. So let's go to the last page. Here we see the same down payment of $79,900, our positive cash flow over the 3 years we hold the property, as well as the positive cash flow and sales proceeds combined in year 4, and that results in an internal rate of return on our $79,900 original investment of 14.19% APR, annual percentage rate. Where else are you going to earn more than 14% per year on your investment? Now, just for curiosity's sake, let's go back on the first page and put in 4% appreciation. You see that increases our proposed future sales price to $467,358, and when we bounce back to the last page, we see our new rate of return on our $79,900 investment is now 17.63% per year. That's not too shabby. So when the listing agent said this home is a good investment opportunity, I'd say she was correct. If you think this home could be a good investment for you, give me a call and we'll do a deeper dive into the numbers and make sure they make sense for you. Or if you're interested in crunching the numbers on a different property, give me a call. I'd be glad to do this analysis for you on any property you might be interested in as an investment. I hope you found value in today's video. If you did, click that subscribe button and click that reminder bell. That reminder bell will notify you when I post new videos. If you like today's video, give it a thumbs up. That's feedback to me that I'm giving you information of value. And finally, please share this link with someone you know who can benefit from the information on this YouTube channel. You can find my email address and my telephone number in the description below. Call me or email me. I'd love to hear from you. And I'd love to represent you in your next real estate transaction. I'm Bob Wolverton. I'm with Pure Real Estate in Bellevue, Washington. Here on YouTube, I'm known as your Northwest Realty Advisor. Every Tuesday morning at 7 a.m., I post new videos about buying, selling, or investing in real estate, as well as some home tours and listing videos. I'll see you next week.